Good morning and welcome to the December 2018 Pearl Planning webinar, Tax Smart Charitable Giving. I'm Melissa Joy and I'll be your host this morning, and welcome. We're going to be covering information about charitable distributions and how you can reduce taxes given the new tax law. Before we get started, I think people often go straight to tax implications of philanthropic giving, but it's important to remember that there is typically or should be a purpose behind the giving in addition to the tax savings. So why do people give? First, you're able to support organizations and causes that matter to you. Additionally, especially at this holiday time of year, it's a good reminder that giving is a great way to teach about money and pass values down and amongst your family. It's a great exercise to test money skills with future generations, and sometimes that gets lost in the shuffle. And third, of course, with no good deed, the good deed of giving also has the wonderful benefit, typically and historically, of the potential to reduce tax obligations for givers. And as we think about why people give, I'd also speak about an intangible that has been captured in studies, in that people feel good about themselves and happier when they're able to give. So that's something that you want to remember and you may feel during this giving season. So with that information, though, it's important to also remember that there have been adjustments to the way that charitable giving may be treated for your taxes. And that comes in the form of the new tax law, the Tax Cuts and Jobs Act, that was passed late last year at the end of 2017. We're really going to start understanding the law better as it relates to your own personal taxes once you've filed for your taxes this year. And since that won't happen until the first or second quarter of 2019, I think a lot of people will be surprised to learn that their typical itemized deductions may or may not be occurring with the new tax law. So there are lower tax rates with the new tax law for many Americans, but there's a higher standard deduction along with the elimination of personal exemptions. So for individuals, while the standard deduction used to be in the $5,000 to $6,000 range, it's almost doubled to $12,000. If you're head of household, the standard deduction is now $18,000. And for joint filers, that deduction is $24,000. And there's extra standard deduction for those over age 65. So how does this impact charitable giving? Well, when you're able to reduce your taxes, it's often because you've itemized your charitable gifts, but itemization only matters if it's in excess of those standard deductions that I just mentioned. And along with the higher standard deductions, there's also limits and caps or eliminations of typical other deductions that many Americans have used, such as caps on state and local taxes, the elimination of itemized personal or miscellaneous itemized deductions, and limitations on home mortgages. So some people estimate that the amount of change that is going to occur in terms of the number of Americans who are itemizing is a reduction as much as 57%. Or I've seen from other sources that only about 10% of Americans are going to be itemizing in the future. And that's significantly down. So you may have thought that your charitable gifts would be something that would be reducing your taxes through itemization, but now Americans may need to go to the drawing board to ensure that they get the best tax benefit for the gifts that they're already planning to give. So let's go over some of the tax smart ways that you can give, and this is basically an outline of what we'll be covering in today's session. First, we'll talk about gifts of your time as well as donating goods, writing checks or giving cash. This is certainly a way you can give. Donating appreciated securities. That's another way to say giving stock that you own that has gone up, as well as donor advised gifts, which are a new and emerging and significantly growing way to give, and the qualified charitable distribution for those over age 70 and a half. And of course, these are coupled with some more sophisticated vehicles that are done by high net worth givers, such as family foundations, charitable gift annuities, and charitable lead trusts. Estate gifts, too, are often included for people that make designations of gifts to charities in their wills and trusts. So certainly all of these are types of gifts that charitable organizations look for and rely upon to do the good deeds that they do. So let's start with gifts of your time and donations of goods. A couple reminders here that some people may not realize. First, if you know you are going to be able to itemize, keep track of your mileage when you're going to a meeting, a board meeting, or doing some volunteer work. That counts for charitable deductions too. You receive you can keep track and deduct 14 cents per mile from if you're able to itemize. And when you donate goods or personal assets, make sure you retain receipts and report an appropriate value. It's not just what you think the value is, it's a fair market value. And monitor your other expenses as well, such as tolls, parking, etc. Now, many of you may not, once you do the calculations, be over that hurdle of the $12,000 for individuals or $24,000 for couples of itemized deductions. Like I've said already, fewer Americans can itemize. But one way that you might consider to get to be able to itemize every few years would be to bundle your charitable gifts and make them in 1 year to be spread out over several. So in that case, first you'd want to know, well, how far away are you from itemizing? And then with the knowledge of how much you would like to be giving, then you may be able to plan so that perhaps you're quite close, and just doing your gifts for 2018 as well as 2019 together would make it work, and you could communicate to the organizations that you are typically accustomed to supporting that, hey, I'm going to be giving you a double gift from what I thought I would give so that I can itemize, but this gift needs to be considered for both this year and next year. I don't plan to be giving next year. And of course, charitable organizations nonprofits love to know your intent. If they just receive a big gift, they may be looking for that in future years, but some kind of forward-thinking communication can always be of assistance both to you as well as to the organization. But this is one common strategy that's being discussed now that we have the significant reduction in itemizing. And keep in mind here that if you do that, then you have the opportunity to, over time, reduce the average taxes that you pay. If you think about it, you could add up several years of taxes, and if you were able to itemize every few years, even every 5 years, then your average tax rates over that period of time would likely be able to go down. Now, many people also may have growth in assets that they own, typically stocks or mutual funds or exchange-traded funds, where the value of that stock, if sold in order to give to a charity, would also have a tax cost associated with it, often as considered a long-term capital gain. So if you have securities that you've owned for more than 12 months, like I said, typically stocks or mutual funds or exchange-traded funds, and they have grown so that there's an unrealized gain. The nice thing about nonprofits or charities is they typically don't have to pay taxes on publicly traded assets that they receive. Thus, instead of giving the organization the cash proceeds of the sale of something, if you give them that appreciated security, you've eliminated a current or future tax liability in the form of a capital gain. So you may be able to give more. And I'm illustrating here an example. If you had $50,000 to give and you'd like to be giving, and making it simple, we're saying, hey, either you're going to sell that amount of money and give it in the form of cash, or you're going to donate the securities. You can see here's the capital gains and Medicare tax surcharge, that is surtax that you would owe if you were to sell, in this hypothetical, the securities. So the net to the organization, or ultimately the net to your taxes, is going to be going down with this method. So that could potentially increase your income tax deduction as well, as you're able to give more and not have to set aside extra assets. So in this case, you're going to want to call the organization and ask if you can give stock, and then get information about their accounts and coordinate between your investment advisors or yourself and the organization so that you're able to transfer those funds, which are typically sold by the nonprofit or organization and thus used for their assets or purposes. To them, it's the same amount of money because they don't pay the taxes. Now, a newer and significantly increasing strategy is to use a donor-advised fund. And this can ultimately fit with your bundling strategy that we discussed before. So this is a fund that will hold charitable gifts for a family until there are recommendations of a gift. And it can either be held in cash or it may be invested so that there's growth over time. But it's a very easy or easier vehicle to receive appreciated stock, for one thing. And the great benefit of a donor-advised fund is at the point in time that you make your gift, you're going to receive a deduction. But then you may dole this gift out to charities over time or at a future date and time. So it allows you to control your deductions. Thus, there's that benefit of bundling, where you don't have to call the charity and say, hey, I'm only going to be giving, I'm giving $5,000 this year, but then I'm not going to give for other years. Instead, you can have control over the point in time that you plan to give. A couple of housekeeping items with the donor advised fund, which could have its own webinar. So, this is just an introduction and you need to do your own kind of research. But this cannot be considered as a way to fulfill pledges. So you want to make sure that you use appropriate language when you're making these types of gifts. Keep in mind that it could be invested to grow over time. It's often funded by appreciated securities, and one great way is if you have too much of a stock, let's say that you inherited a big position or have had significant stock growth with because of a company that you work with. This is a great source to kind of fund that, and it's going to go back and help with bundling strategies if you're looking to do that. And donor-advised funds are becoming quite popular. So this is a look at the National Philanthropic Institute's report on the percent of individual giving that is coming from donor-advised funds. And certainly there are some significant philanthropists that have started to use these funds, but they're also kind of an everyman or everywoman fund or strategy. So what we've seen is a move from about 4% of total individual giving to more than 10% in the last 7 years. So it's a really interesting phenomenon, and I think it's going to be spurred along more because of the Tax Cuts and Jobs Act. So another significant strategy, when we look at trends of givers, there are several groups, and they're large groups, that are seen as kind of the backbone of charitable giving. Millennials, women, and older Americans are also significant givers. So also older Americans, those over age 70 and a half who have retirement plans, individual retirement accounts, 401ks, 403bs, have a required minimum distribution. Probably many of you are aware of this because so many Americans are using defined contribution plans like these retirement plans in order to fund their retirement. Well, if you were formerly itemizing and find yourself, because many of these category of Americans also have, their mortgages paid off, so they don't have that mortgage interest to deduct, and just might not be as likely to deduct with the new tax law, then instead, if they also have a required minimum distribution that they're required to do, they can gift directly to charities instead of receiving a check and then writing that check over to the charity. If they send the money directly to charities, then they can get a gift. And we've seen this qualified charitable distribution going back as far as 2006, but it was always lapsing and then coming back in for a brief period of time. But in 2015, the qualified charitable distributions became permanent. So if you have an RMD, a required minimum distribution, and you have an IRA, this is not something you can do in your 401k or 403b. So that's important to consider. Then you can make a gift up to $100,000, which may be more significant than what your required giving is. and that will then not be reported as ordinary income on your taxes. So instead of itemizing, you're going to be reducing your reportable income. Now, this must go to a public charity, and it's important to remember to tell your CPA or tax professional or remind yourself if you're self-preparing that you made these gifts, because sometimes the reporting is not good at letting you know that this was a qualified gift. But this is a great way to reduce tax cost for the older segment of Americans, a great strategy. So that is a quick introduction. Tried to keep it short and simple, less than 20 minutes, of how you can make tax qualified or tax smart charitable gifts. A couple reminders before we go. First, remember, you should consult with your tax advisor, financial professional, estate planning attorney, or those trusted individuals that help you with advice. This is a general informational session, and your specific or unique needs cannot be addressed without knowing your personal circumstances. Second, your itemizing or the most tax efficient way for you to give may be changing over time. So make sure you review this and don't keep it on autopilot unless that's appropriate. Third, I think it's great if you're able to coordinate with a nonprofit, church, or religious institution or charity that's most important to you. That can deepen and increase the meaningfulness of your giving. So it's important, to remember that they often will appreciate both your time and communication as well as your financial support. And finally, make sure that your charitable intent is true to your heart, not just your tax lens. With that, thank you so much. If you have follow-up questions, please reach out to me at Pearl Planning. Here's some information about my contact information. And again, thank you for the time and have a wonderful holiday season.